Everybody that's investing anything at all should have at least seen this chart once. This is the Shiller PE ratio. It shows the price to earnings ratio of stocks of the S&P 500 historically. Whenever we buy stocks, essentially what we're doing is we purchase the future earnings of a company, and the current market cap of a company versus the current earnings, that ratio, that's the PE ratio. Now why Shiller? That's just the inventor of that metric. We average out the PE ratio over 7 years to take away some cyclicality from the measure. So currently stocks are incredibly expensive, historically speaking. This chart starts in 1870. Now this here is a crypto channel. Why am I even talking about stock valuations? It's because there is a connection here, especially between tech stocks and crypto prices. The chart at the top shows the Bitcoin price. The chart at the bottom shows the Nasdaq 100. And those vertical lines are simply turnaround points. In other words, Bitcoin bottomed at the same time as the Nasdaq 100. It also topped at the same time as technology stocks. It then bottomed again at the same time. It topped, it bottomed. Those two lines, they are not 100% the same, but they tend to trend in the same direction. And so that's why the Shiller PE ratio is so important. Now, with the current PE ratio of 40, it means it takes 40 years to recoup our initial investment if you just look at earnings, not even at dividend payments. Now, historically, that's high, but what does this actually mean? 100 divided by 40 is 2.5. So there's an inherent interest rate of 2.5 embedded in stocks if the earnings were not to grow. This compares to the risk-free rate, which is currently at 3.75%. Or we could flip this, right? The PE ratio, so to speak, it's a very uncommon measure for bonds, but the PE ratio for US Treasury bonds is at 26. 40 for stocks, 26 for bonds. Now for bonds, we know for certain that the future earnings won't grow. For stocks, we do have that expectation, and that's where there's also this mismatch. And so the straightforward story here is simple, right? Stocks are historically very expensive. Stocks are correlated with crypto. When stocks crash, then crypto will follow. But is it that simple, really? Are we going to see a turnaround when the PE ratio gets closer to 45? This here, that was the .com bubble burst. The second correction, that was the global financial crisis. Have a look at the Nasdaq 100 relative to the money supply. So we don't just want to look at the technology stock prices directly, we want to put them in relation to the monetary debasement. Because very long term, many stocks just go up because the US dollar gets devalued over time. More and more US dollars circulate. So the USM2, the US money supply, grows by roughly 6.8% per annum. And we have to adjust for that growth. So this is the performance of technology stocks if we did not have any monetary debasement. We are looking at a crash of 87% over the course of 9 years. Again, first the .com crash, a slight recovery, and then the global financial crisis. And so since 2009, the Shiller PE ratio is going up, and the Nasdaq 100 relative to the monetary base is going up as well, and that's by more than 700%. And so things appear to be heated, but maybe there's another story. Maybe this is not the realistic way to look at things, because the peak in the year 2000 was already way higher compared to the peak before the Great Depression in 1930. Maybe this is a more realistic picture. Now, why is this potentially also a realistic scenario? Why could the PE ratio, why could stock valuations on average relative to the earnings long term go up? I think the answer here is capital concentration. Over time, capital tends to concentrate in fewer and fewer hands because there's a part of the population that just makes enough money to survive. There's another part of the population that can save and then even compound those savings via investment. So there's one part that simply grows the capital base all the time, that gets richer and richer, and there's the rest that's generating all of those productive returns that can't grow the productivity as quickly as the money gets accumulated. So in other words, savings and the capital base might be growing faster than productivity gains than the operational income. This is also what we see in other statistics. Household income in general tends to grow slower than household wealth. And that then explains why the Shiller PE ratio goes up over time. Capital returns should go down. And that's an expression of a higher PE ratio, right? It costs more money to buy future earnings because the future earnings don't grow as quickly as the savings do. Still, of course, we wouldn't be extremely cheap right now, but we might not implode tomorrow. We might still see another 10-20% outperformance versus monetary debasement. And again, the growth rate of the US dollar base is 6.8% per annum. We grew by 77x over the course of 66 years. That's 6.8%. This is now on a linear scale. Here's the same on a logarithmic scale. The growth is relatively constant. It's relatively predictable. I actually think that the theory that PE ratios very long term are going to increase and that capital gains very long term will decrease is the most likely scenario. In other words, I think this here is more likely than this here, because there are other data points that support this theory. Have a look at the US debt to GDP ratio. This is going up since 1981. So the US is getting more and more indebted. The Gini coefficient in the same time frame also went up. The Gini coefficient is a measure of how unequal wealth is distributed. And what does it really mean when the government is in debt? It means that some people hold government bonds. And those are again the people that were saving. This can be within the US, this can be outside of the US, but in general it's just a global trend of capital concentration. Returns across the board are going down. This is not just true for stocks, this is also true for property, this is also true for all kinds of other asset classes. Because how does it make sense that gold relative to the US money supply is on a massive rally? But at the same time, technology stocks, so risk on assets, are also going up. How can something that's risk on go up and something that's risk off go up as well? It does not make any sense, right? If the economy is super healthy, then technology stocks should go up, risk on assets should go up. If the economy is not healthy, then gold as an alternative investment should go up. Why can both go up at the same time? It's simply because too many people have too much savings. And with too much, I simply mean a lot in historical context relative to what we productively earn in the economy. Because returns are generated through productive activity if it is not just monetary debasement. So this is gold just short term. Here is a longer term chart. This starts in 1960. The dotted line, that's the average ratio of the gold price relative to the monetary base. And gold definitely is currently not very cheap. It's 68% above its historical average price relative to the US dollar. And so what's the fundamental implication here? If stock prices are currently very high and they might be coming down, what will that then mean for Bitcoin? What will that then mean for crypto? The answer is we do not really know in detail. It's probably not going to be great because again, Bitcoin and stocks are highly correlated. They move in the same direction at the same time. This is a longer term chart again. This is the S&P 500 relative to the monetary base. We are at very similar levels to the peak of the dot-com bubble. Where was Bitcoin created? The answer is here. We have never lived through a real crisis like dot-com or the global financial crisis during Bitcoin's existence. And this is why I think many people underestimate the risk that crypto really has. I am a fan of using cryptocurrency to generate returns, but I'm not a fan of having 60, 70, 80% of net worth in the sector. It's very, very wise to diversify. It also makes sense to buy things that potentially aren't yet that high, or to simply just keep some money in cash as well. There might be also a crisis coming at some point. Because even though it might not come immediately, even with this more optimistic view, we aren't necessarily extremely low in that range. 2.5% inherent return with stocks. That's not high at all, especially in the context that the monetary base devalues by 6.8% per annum. My generation and everybody that's younger, I'm now approaching the 40 years, has pretty much only seen a bull market. We might have seen the global financial crisis while we were studying, but at that time we didn't really earn much money. At that time we didn't have a lot of money to invest. Really, since we are working, since we are saving, all we saw was very high returns across the board. And this is context many people do not have. And that's why I think my generation on average will get wrecked. You might think that you are diversifying because you bought some Tesla stock together with your Bitcoin, but really you are not. Even approaches that were pretty straightforward, let's say dollar cost averaging into Bitcoin, $1,000 every month for the last 6 years, that would have resulted in $250,000 or 2.7 Bitcoin during that time frame. Even approaches like this aren't that foolproof anymore. It seems like a safe strategy, but really, given this chart and the potential risk that that chart implies, it's not that safe of a strategy. The safer strategy is really diversification. And with diversification, I do not mean buying many different altcoins, buying many different stocks. I mean buying things that have very little correlation. Potentially even buying things that might go up when everybody is panicking. Now gold might be one of those things, but gold is already very expensive as well. It might be simple things like government bonds, long-term government bonds. Let's say the big crisis comes, then the Federal Reserve has to cut interest rates again, and then prices of long-term bonds will go up. Now everything has its own risk. Now I am not saying that buying long duration bonds with a lot of interest rate exposure have no risk. The only thing I'm saying is it makes sense to be exposed to different kinds of risk. There's definitely one massive risk in the market, a risk that's overlooked, and that's the capital concentration. Most people that make money during a bull run tend to lose the majority of it when we go down. Especially this cycle has been long enough for people to forget what real bear markets feel like. People get unemployed, savings rates turn negative, and nobody has money to buy the bottom actually. It looks so easy on the chart, right? Just buy when it dips. But in reality, it was very hard to have a lot of savings in 2009 to buy those dips. Warren Buffett was able to do so. By the way, Warren Buffett also now has a historically high cash rate as well. If it's your first time here, feel free to subscribe. I publish videos regularly. Feel free to also check out the premium membership. This is where I share what I personally do in order to potentially avoid a crash that might be coming. Not tomorrow, not the day after tomorrow, but over the next 10 years, I don't think we'll continue just going up like this. The vast majority of investors will get wrecked. Times will get hard again, but there are ways to get protected even when everything seems expensive. Looking forward to seeing you again in YouTube. Also looking forward to seeing you here in Premium. See you next time. Cheers.